Ladies and gentlemen, let me ask you something before we begin. What if the biggest moves in the global economy are happening right now, right in front of us, and most people are completely blind to them? What if the price flashing on your screen today is not the truth, but a carefully constructed illusion? Tonight, I want to talk to you about silver at $66, China dumping 660 tons, banks quietly going long, and the $89 trap that almost nobody sees coming. This is not just a story about metals. This is a story about power, timing, and who really wins when the system resets. Right now, the headlines want you distracted. They want you arguing about short-term price moves, daily volatility, and surface-level narratives. But serious money does not think in days or weeks. Serious money thinks in cycles. And when you step back and look at the cycle unfolding in silver, something extraordinary becomes clear. China does not dump metal out of panic. China dumps metal with intent. When 660 tons move out of official channels, that is not weakness, it is positioning. It is a message to the market, and most people are reading it completely wrong. Here is the hook most people miss. While China is releasing supply, Western banks are quietly doing the opposite. They are not selling fear. They are accumulating certainty. The same institutions that publicly question silver's upside are loading their balance sheets with long positions. They understand something fundamental. Price suppression only works until physical reality takes over. Paper contracts can multiply endlessly, but real metal cannot. And when that tension breaks, it does not break gently. Silver at $66 feels expensive to the unprepared mind. It feels like you already missed the move. But history teaches us a brutal lesson. Real breakouts always feel uncomfortable before they feel obvious. Every major bull run begins by convincing the crowd it is too late. That psychological barrier is intentional. It shakes out weak conviction and transfers opportunity to those who understand the game being played behind the curtain. Now let's talk about the $89 trap. This is where motivation meets discipline. The trap is not the number itself. The trap is what happens when silver approaches it. At $89, the media will scream bubble. Analysts will warn of collapse. Governments will talk about stability. And retail investors, driven by emotion, will rush in late, buying headlines instead of fundamentals. Meanwhile, the institutions who positioned early will distribute into that frenzy with calm precision. That is how traps are built, not to stop you from entering, but to force you to enter at the worst possible moment. The lesson here is not about silver alone. It is about mindset. Winners in any economic cycle are not the loudest or the fastest. They are the most patient. They study behavior, not noise. They recognize that when nations move metal and banks move capital in opposite directions, something structural is happening. And structural shifts do not reverse overnight. They redefine decades. If you are waiting for certainty, you will always be late. Certainty only appears after opportunity has passed. The people who win are those who can act while the story still feels incomplete, while the outcome is still uncomfortable, while doubt is still loud. That is not recklessness, that is informed courage. China's release of 660 tons of silver is a strategic liquidity move, not a bearish signal. Historically, large sovereign disposals occur when a nation is relocating capital or influencing price discovery, often to support downstream industrial demand or manage currency exposure rather than exit the asset class. Western banks increasing long exposure, while public narratives remain cautious signals a classic divergence between institutional positioning and retail sentiment. This gap typically appears in the early to mid stages of a structural bull cycle, when accumulation is quiet and price remains politically manageable. The 66 silver price represents a psychological resistance zone rather than a fundamental ceiling. At this level, perception of expensive suppresses participation, allowing institutions to build positions without triggering a disorderly repricing of physical supply. Paper silver markets continue to expand leverage far beyond available physical inventories, increasing systemic fragility. When physical delivery constraints tighten, price discovery shifts abruptly from derivatives to real world supply, producing nonlinear upside moves rather than gradual appreciation. The projected 89 level functions as a behavioral inflection point where media narratives, regulatory rhetoric, and retail inflows converge. This zone historically marks heightened volatility as early institutional entrants begin risk reduction, while late entrants amplify short-term price extremes. The broader implication is a cycle-driven transfer of wealth based on timing and conviction, not prediction. Investors who recognize policy actions, institutional behavior, and supply dynamics early position themselves ahead of repricing events, while those reacting to confirmation absorb the volatility created by that transition. China's release of 660 tons of silver should not be interpreted through the narrow lens of panic selling or bearish capitulation. Nations operating at China's scale do not react emotionally to price movements, they engineer outcomes. When a sovereign actor deploys metal into the market, it is rarely an exit from value and almost always a recalibration of leverage, liquidity, and strategic control. The first hook most observers miss is this. Dumping metal does not mean abandoning belief in the asset. It often means using the asset to reshape the battlefield. Silver occupies a unique position in China's economic architecture. It is both a monetary hedge and a critical industrial input, embedded in solar technology, electronics, medical devices, and advanced manufacturing. By releasing significant quantities into global circulation, China influences downstream pricing without sacrificing long-term access. This maneuver helps stabilize domestic manufacturing costs at a time when global supply chains remain fragile and geopolitical trade routes are under stress. The market sees supply pressure, China sees cost control and industrial resilience. Another critical dimension lies in currency strategy. Silver, like all hard assets, is indirectly tied to confidence in fiat systems. By mobilizing physical silver, China creates liquidity that can be converted into foreign exchange, trade credits, or strategic imports without expanding visible currency reserves. This reduces exposure to dollar-based systems while maintaining flexibility. The hook here is subtle, but powerful. Silver becomes a silent currency, moving value without flashing signals that trigger political or financial retaliation. This action also serves as a pricing message. When a major holder introduces supply at elevated price levels, it suppresses speculative momentum and delays retail euphoria. That delay is valuable. It prevents runaway prices that could attract regulatory attention or destabilize partner economies reliant on affordable industrial metals. In effect, China is smoothing the curve, not breaking the trend. History shows that true trend reversals are chaotic and disorderly. This move is controlled, measured, and deliberate. Perhaps the most underestimated aspect is signaling to institutions. Large-scale releases inform banks and sovereign funds that physical metal is being used tactically, not emotionally. That knowledge shifts behavior. It encourages long-term players to position with patience, anticipating that once strategic releases conclude, the underlying supply-demand imbalance will reassert itself with greater force. The hook here is timing. Strategic selling today often accelerates scarcity tomorrow. In economic terms, this is not distribution at the top, it is inventory management within a long cycle thesis. China is not walking away from silver's future. It is actively shaping the conditions under which that future unfolds. Those who mistake this for weakness reveal a deeper misunderstanding of how power operates in commodity markets, where control over flow matters far more than ownership of stockpiles. The widening gap between institutional positioning and public narrative is one of the most reliable signals in macroeconomics, and the current behavior of Western banks in the silver market fits this pattern with striking precision. While official commentary remains cautious, even dismissive, balance sheets tell a very different story. Banks are not increasing long exposure because they are optimistic. They are doing so because risk models, liquidity forecasts, and counterparty data are aligning in a way that makes not being positioned the greater danger. The first hook is simple but uncomfortable. When banks speak conservatively and act aggressively, their actions always deserve more attention than their words. Public narratives serve a function. They manage expectations, suppress volatility, and prevent disorderly capital flows. Banks understand that openly endorsing upside in a strategic commodity would accelerate speculative demand and compress their own entry window. Silence and skepticism, therefore, become tools. This creates a vacuum where retail participants hesitate, believing uncertainty equals risk, while institutions quietly absorb exposure at prices that still appear politically and psychologically acceptable. What makes this divergence powerful is timing. Historically, banks increase long exposure during periods when price action appears frustrating and range-bound. These are not moments of excitement but moments of preparation. Volatility is low, participation is thin, and headlines lack urgency. That environment allows large positions to be built without triggering price dislocations. The hook here is counterintuitive. The most important accumulation phases feel boring, confusing, and unconvincing to the public. There is also a structural incentive driving this behavior. Banks are not trading silver as a short-term bet. They are positioning against systemic stress. Rising sovereign debt, persistent inflationary pressure, and tightening physical supply chains elevate the value of assets that sit outside pure credit risk. Silver, unlike many financial instruments, carries no default risk and increasing industrial indispensability. This dual role makes it particularly attractive to institutions tasked with balancing yield, liquidity, and long-term resilience. Another layer often overlooked is hedging complexity. Banks operate within interconnected markets, rates, currencies, energy, and metals. A long silver position can offset risks elsewhere in the system, especially during periods when monetary policy credibility is questioned. The hook is that silver is not being bought for its price alone, but for what it protects against when confidence fractures. This divergence ultimately creates asymmetric risk. Retail investors waiting for confirmation face rising entry costs, while institutions positioned early absorb volatility with structural patience. When narratives eventually shift, and they always do, the repricing tends to be abrupt. By the time optimism becomes public, accumulation is complete, and the market transitions from quiet positioning to visible revaluation, leaving late participants exposed to the very volatility they were trying to avoid. Silver trading near $66 creates a powerful psychological barrier that has little to do with fundamentals and everything to do with human perception of value and regret. Investors are conditioned to anchor decisions to past prices, and when an asset moves decisively higher, the dominant emotion is not excitement but hesitation. The mind whispers that the opportunity has already passed. That buying now means becoming the exit liquidity for someone else. The hook is that this discomfort is not accidental. It is a necessary feature of every sustained bull cycle. Markets do not reward comfort. They reward conviction formed before certainty. At $66, silver feels expensive precisely because it has already survived disbelief. This level represents a transition zone where early adopters are in profit, skeptics remain vocal, and late participants are paralyzed by fear of mistiming. From a macroeconomic perspective, such zones are not ceilings but pressure chambers, where demand quietly strengthens while participation remains artificially suppressed by emotion. Fundamentally, nothing about the silver market at this price suggests excess. Industrial demand continues to expand, driven by energy transition technologies, electrification, and advanced manufacturing. Supply growth, meanwhile, remains constrained by declining ore grades, underinvestment in mining infrastructure, and geopolitical friction in key producing regions. Yet, despite these realities, the narrative of too expensive persists. The hook here is that perception lags reality, and price often pauses not because value is exhausted, but because belief has not yet caught up. This psychological resistance serves institutions well. As long as the majority perceives $66 as risky, accumulation continue without triggering the self-reinforcing feedback loop that drives rapid price escalation. Retail hesitation becomes institutional opportunity. History repeatedly shows that the longest consolidations occur not at market tops, but in the middle of structural trends, where price must spend time convincing participants that it deserves to be higher. There is also a behavioral asymmetry at work. Those who bought lower fear giving back gains, while those who missed the move fear buying the high. Both groups hesitate, reducing turnover and volatility. This stagnation is often misread as weakness. In reality, it reflects balance, not breakdown. The hook is subtle. True weakness is chaotic selling, not disciplined waiting. Economically, $66 functions as a filter. It removes speculative excess while retaining strategic interest. It is high enough to discourage impulsive entry, yet low enough to remain attractive to long horizon capital. When such a filter holds, the market builds a stronger base for future moves. The danger is not that silver is too expensive at this level, but that waiting for emotional comfort often means paying a much higher price later. When hesitation finally turns into urgency, the modern silver market is increasingly defined by a widening disconnect between paper claims and physical reality, and this imbalance is not a theoretical concern but a measurable source of systemic risk. Futures contracts, options, unallocated accounts, and synthetic instruments have multiplied far beyond the amount of deliverable metal that actually exists. This structure functions smoothly only as long as confidence remains intact. The first hook is unsettling but essential to understand. Leverage is not dangerous when everything goes right. It becomes explosive the moment something goes wrong. Paper markets were designed to provide liquidity and price discovery, not to replace the underlying asset. Over time, however, financialization has allowed silver exposure to be created almost endlessly, while mine supply and above-ground inventories grow slowly, if at all. This creates a fragile equilibrium where price reflects confidence in settlement mechanisms rather than true availability. As long as participants are content with cash settlement, the system appears stable. The moment physical delivery becomes the priority, the illusion begins to fracture. Physical demand does not announce itself with headlines, it tightens quietly. Industrial users secure supply months or years in advance. Sovereign buyers move through bilateral channels. Refiners and fabricators reduce available inventories as a precaution. None of this immediately shows up in paper pricing, but it steadily drains the buffer that paper markets rely on. The hook here is subtle but powerful. Scarcity builds invisibly until it suddenly becomes undeniable. When delivery stress emerges, price behavior changes character. Markets no longer move in smooth increments guided by technical levels or sentiment indicators. Instead, they gap, spike, and overshoot. This is because paper sellers are forced to compete with real, world buyers who cannot substitute contracts for metal. At that point, price is no longer a negotiation, it is a rationing mechanism. Those who assume liquidity would always exist discover that liquidity was conditional, not guaranteed. History offers repeated warnings. In moments when physical constraints override financial structures, derivatives lose authority over price. The silver market's high leverage ratio means that even a modest increase in delivery demand can cascade into outsized price reactions. The hook is this: it does not take a shortage of all silver, only a shortage of silver available at the promised time and place. From an economic standpoint, this creates asymmetric risk. Downside becomes limited by production costs and strategic demand, while upside becomes uncapped by the need to reprice scarcity rapidly. Participants positioned solely in paper instruments face settlement risk and volatility they did not model. Those aligned with physical reality benefit from the transition from synthetic abundance to tangible constraint. In such environments, the market stops rewarding clever trading strategies and starts rewarding alignment with what actually exists, exposing the difference between perceived supply and real supply in the most unforgiving way possible. The $89 level is not important because of the number itself, but because of what it does to human behavior once silver approaches it. Markets do not turn dangerous when prices are low, they become dangerous when confidence replaces discipline. As silver moves toward this zone, the narrative will shift rapidly from skepticism to inevitability. Media coverage intensifies, analysts revise targets upward, and the same voices that once warned against risk begin framing participation as common sense. The hook is simple and unsettling. The moment everyone agrees is usually the moment risk quietly peaks. At this level, volatility stops being technical and becomes emotional. Retail inflows surge, not because fundamentals suddenly changed, but because fear of missing out overwhelms caution. Price action accelerates as late entrants chase momentum, mistaking speed for strength. This is where the trap forms, not through deception, but through collective psychology. Markets do not need to mislead participants when participants willingly abandon patience. Regulatory and political rhetoric also tends to re-enter at these inflection points. Rising prices in strategic commodities attract attention from policymakers concerned with inflation optics and financial stability. Statements about market excess, speculation, or consumer protection begin circulating. These do not immediately reverse trends, but they inject uncertainty at precisely the moment enthusiasm is highest. The hook here is timing. Scrutiny always arrives after positioning is complete, never before. Institutional behavior subtly changes in this environment. Banks and funds that accumulated during periods of doubt begin reducing marginal risk, not by exiting entirely, but by rebalancing exposure. Liquidity provided by new entrants allows this transition to occur smoothly. To the outside observer, the market still appears strong. Underneath, leadership quietly rotates. This is how volatility is transferred from experienced hands to inexperienced ones, without a single headline announcing the shift. Another layer of risk emerges from leverage. As price rises toward widely discussed targets, margin usage increases. Traders stretch position sizes, assuming continuation will bail out excess exposure. This makes the market fragile. Any sharp counter move, policy comment, or liquidity event can trigger forced selling, amplifying price swings in both directions. The trap is not that silver reaches $89, It is that many arrive there without a plan, overexposed and emotionally invested. Economically, this zone represents a convergence of optimism, visibility, and crowd participation. These conditions do not end bull markets on their own, but they dramatically change the risk profile. Those who entered earlier face decisions about protection and patience. Those entering late face compressed margins for error. The market does not punish belief, it punishes unprepared belief. In that environment, success is determined less by what one owns, and more by whether one understands where in the cycle they are standing. The larger story unfolding in silver is not ultimately about price targets or short-term predictions, but about how wealth moves during major economic transitions. Every long-cycle repricing event follows the same pattern. Early signals appear quietly, participation is limited, narratives are conflicted, and conviction is required long before confirmation arrives. Those who recognize these early signals are not guessing the future. They are responding to present conditions that most are trained to ignore. The hook is uncomfortable, but true opportunity rarely announces itself with clarity. It whispers through imbalance and contradiction. Cycle-driven wealth transfer is rooted in behavior, not intelligence. Access to information has never been more widespread, yet outcomes remain uneven because interpretation differs. Some wait for permission from consensus, while others act on structural evidence. In the silver market, policy distortions, institutional positioning, supply constraints, and rising strategic demand form a coherent signal set. Ignoring these because price is not yet proven, the case is itself a behavioral choice, one that historically favors those already positioned. Timing in such cycles is not about precision, it is about alignment. Participants who position early are not immune to volatility, but they experience it differently. Volatility becomes noise rather than threat. By contrast, those who enter after confirmation experience the same price swings as existential risk. The hook here is psychological, the market feels safer later, even though it is objectively more dangerous. Conviction, in economic terms, is not stubbornness. It is the ability to maintain exposure through uncertainty because the underlying thesis remains intact. Long-cycle investors understand that drawdowns, consolidations, and narrative attacks are not signs of failure, but mechanisms through which markets test resolve. This is why wealth transfer accelerates during these phases. Positions are not taken from the unprepared by force, but surrendered voluntarily through doubt. There is also a compounding effect at work. Early alignment allows for flexibility. Decisions can be made from a position of strength rather than urgency. Risk can be managed, exposure adjusted, and opportunities evaluated without emotional pressure. Late alignment removes these advantages. Every decision becomes reactive, every pullback feels threatening, and every rally feels like a second chance that must not be missed. The hook is this emotional pressure, is the hidden cost of waiting. Economically, the silver cycle illustrates a broader principle applicable to all assets influenced by policy and scarcity. Markets eventually reprice to reflect reality, but they do so on their own timetable, not according to popular expectation. Those who benefit are rarely those with the best forecasts, but those with the discipline to act when clarity is absent and patience is tested. In that environment, wealth does not move suddenly, it moves steadily. From hesitation to conviction, from reaction to preparation, and from those who seek certainty to those who understand cycles well enough to live without it. So as you walk away from this, remember this moment. Remember that silver at $66 is not a destination, it is a checkpoint. Remember that China's move is not fear, it is strategy. Remember that banks going long is not coincidence, it is preparation. And remember that the $89 trap is only dangerous if you arrive without a plan. The economy does not reward hope, it rewards awareness. It does not reward emotion, it rewards discipline. And it does not reward those who follow the crowd, it rewards those who understand the cycle before the crowd even realizes a cycle exists. Stay sharp, stay patient, and most importantly, stay ahead of the story. Because the real opportunity is never where everyone is already looking.